Okay, good afternoon, everyone. I think we might get going with this afternoon's session. Just to kick off with some housekeeping before we get on to the main discussion point. Today's session is with the FAAA for accreditation. You'll receive details of the CPD information via email in the next couple of weeks. If you do have any questions during today's webinar, we do encourage you to submit those through the Zoom Q&A. Hopefully we'll have time to address them at the end. If we don't have time to answer all of your questions, we will ensure that we get back to you with responses post the session. We'll also be sending through a recording of the session and a copy of the deck in the coming days for everyone that has attended today. As always, we really do value your feedback to ensure that we continue to improve on these sessions. So we'd really appreciate you answering a couple of survey questions at the end of today's session. Just in terms, before we kick off, just a reminder that today's presentation is general in nature and cannot be seen as advice. As such, we've not considered anybody's personal objectives, financial situation, or particular needs in today's presentation. Okay, well, let's get on to the main part of this session today. I'd like to welcome Bianca and Bryce, senior portfolio members, senior portfolio managers, I should say, in our investment team that was recently recognised by the Financial Newswire Fund Manager of the Year Awards, where the team was recognised for our multi-asset capability in both the managed accounts sector and our multi-sector growth, and was runner-up in the overall Fund Manager of the Year. So Bianca, Bryce, congratulations. Great to have your focus on delivering risk-adjusted returns for investors recognised. We're going to get into some of the details of our investment process, but really just to, I think, initially just set the stage for everyone. I thought it would be good if you could just elaborate on the underlying philosophy or investment principles that really do govern our process here at Morningstar.
Sure. Great to be here. Thanks for the introduction, Chris. So I guess a successful investment capability is like building a house. You need solid foundations, and our investment principles are pretty much the bedrock of that and inform everything we do and how that feeds into our investment process. So simple but important, and have three of them, three key ones. So the first one being we champion investors. I think a mantra that runs through our business is empowering investor success, and we believe that the client wins, we all win. And so that's at the heart of all our decisions in terms of all decisions are made with the end investor in mind and what is best for them.
So looking at our second investment principle, we take a fundamental approach. So for us, whether it's appointing external manager strategies where we're looking at the quality of the investment personnel, or whether we're directly making the asset allocation decisions or direct stock picking, we're always looking at the fundamentals. So we might be looking at the investment's future earnings, and that will serve as our anchor to kind of say what is the kind of true intrinsic value of an investment. And we kind of think that's important for us to have that anchor of fundamentals. It really kind of helps us stand behind our investment views, even if they are unpopular. And that means that we can then ride out market volatility over the short term and look to long term on that path.
And the third and final one is we believe that price matters. Now, price is probably one of the few things in a really uncertain investment markets that are uncertain that you can control. You can control that through what you pay for an investment manager, what you pay for an ETF, and then I think importantly for our process, what you pay in our asset allocation process, what you pay for an asset. So the price you pay for an asset matters for how you build wealth and build wealth in the long term.
Okay, so let's maybe just explore that last point a little bit in a little bit more detail, it's pretty fundamental, I think, to everything that sort of guides your process. So the difference between price and underlying sort of intrinsic value.
Yep.
And I think Buffett was the one who sort of said, price is what you pay, value is what you get. So maybe just dive a little deeper into that and just help
Sure.
everybody understand why that is so important to everything that you do in your process.
Sure. So our process, our approach to asset allocation, which is effectively what in our multi-asset portfolios we're implementing, is valuation-driven asset allocation. And what that means is we're focusing on trying to buy undervalued assets below their fair value with a margin of safety. Now, why are we doing that? Now, if we buy cheap assets below their fair value, that leads to outsized returns in our view. And then the second part of that is, I guess, the flip side of return is that if you buy an asset cheap, you protect yourself from greater potential losses and permanent impairment of capital, which is really what investors are concerned about. Now, what is fair value? So fair value is what you should pay for an asset. And really what is fair value for a particular assets will be different. So if we think of a collection or what companies that are in the IT sector, their fundamentals and what determines is all the cash flows that come out of their businesses. So what comes through in dividends and buybacks or underlying share growth, underlying sort of cash flow growth. And then how the fair values of that will differ to, say, a consumer staples company, which might have different drivers in terms of what makes up fair value. And then that's the fair value of an asset, and then the price oscillates around that. Now, a really important concept is margin of safety. Why margin of safety? So you want to buy things that you think value is here, and then you want to be buying much further below that. Because frankly, you've got to be humble enough to realize that you don't know everything. There is information out there that is important but unknowable, and you want to factor that in to your decisions such that you control for that uncertainty by buying at a steeper discount. And that you have these oscillations in price around our fair value, and that's how you're starting to think about making decisions around that disconnect between what the price is and what the underlying value of an asset is.
So it's a very, obviously stylized chart that we've got here, but just to sort of replay back to you, I think what I heard there, Bryce, is just, and you see it in here, is that the fair value is pretty stable.
Yeah.
It's knowable. You can obviously determine that the price is going to be volatile and oscillate around that. So just thinking about how you sort of time your, when you enter an exit position, so it seems to be one of the key takeouts of the slide.
Yeah, totally. So buy low, sell high, pretty easy concept. And I think we've got a history of showing that through our process.
So just having a look here, and while this kind of animation kind of comes through, in terms of what we've got here, in terms of the red line is really the long-term history of the global equity market. And what we kind of talked about in terms of the short term, you're going to see fluctuations, and they look like very small blips when you kind of compare it to the long term, where obviously has been an upward trend. When we think about equity markets over the long term, they are tracking the fundamentals and in particular earnings growth. But what fluctuates in the short term is the price and what investors are willing to pay, as Bryce just spoke about in terms of a stylized view. Here's a view from the global equity market. And so what we see is over the short term, we have seen a number of market events or shocks, if you like, that influence investors' views on the price they're willing to pay for those fundamentals. So through time, we've had many different events, some positive, sometimes more so negative. But nevertheless, we have seen through it all, the market, goes up. And really what we have at the bottom here is what we kind of, internally refer to as our vintages or our investment opportunities. And we refer them as our vintages because they tend to have different maturities. And, when we kind of get into them and when we get out of them can be different durations. And you can see there's some play out quite quickly, and we don't know sometimes that it's going to play out that quickly. And some have been quite longer in duration just because there are a few more legs to that kind of vintage, if you like.
So, I mean, maybe just let's explore that just a little bit further, Bianca. So, let's pick on Japan equities because that looks like the longest position that we actually have there. Can you just give perhaps a little more insights into what you were thinking there and why that took, what looks like an extraordinarily long time to sort of play out? And how does it compare to, say, a normal cycle?
Yeah, so a normal cycle for us is probably about 3 years. This is a much longer duration, and we knew that going in. With Japan in particular, as people probably would have heard a lot about today, is all about corporate governance. But over a decade ago, that was kind of seen as a very unlikely thing to happen. And so we've had to be quite patient there. But also along the way, we've seen a number of legs to this particular position. So for us, yes, it has been about corporate governance. And what do we mean by corporate governance? We really mean about putting shareholders first. So in Japan, it's quite an unusual case, particularly when you contrast it with the US equity market, where it is all about the shareholder. In Japan, it's all about the other stakeholders, so employees, customers, the society in Japan is a very big thing, and it's not necessarily about shareholders. So what we've seen, though, is that has really started to change with government initiatives, some structural reforms, and they've taken a long time to play out. The other part that is probably less well understood about Japan, aside from corporate governance, is interest rate and inflation cycle has been very, very different to the rest of the world. So as we know, for the kind of past 2 decades, Japan has been in a deflation kind of a scenario until the last few years, and everyone was saying, oh, inflation's a worry for the rest of the world. Well, guess what? This is probably one area that actually really benefits from high inflation because it took it out of deflation, if you like. And it's also another area that's uniquely positioned to not only benefit from rising inflation, but also rising interest rates. So for us, we've had a number of legs in that period where we've had active managers that are focused on corporate governance and also domestic Japan positions outside of the exporters. We've also had passive positions, like when we had the Japanese earthquake where we saw price drops, and so we've bought into that. And we've also had some direct stock positions in some financial stocks there, which is benefiting really from that interest rate and inflation story.
Okay, perfect. One of our other investment principles that you sort of called out earlier is being independent-minded, or, I suppose put slightly differently, being contrarian. Any examples in those vintages that sort of evidence that independent sort of thinking, and or when we've invested against the crowd or against consensus?
Sure. So I think a really, really big one was during the COVID-19 pandemic, and specifically calling out global energy and our position in global energy across both Europe and the US. So to put it mildly, and you can see it on that chart really, like COVID-19 was an extraordinary time for investment markets when you consider not only the size of the drawdown, but the pace. So all of that drawdown happened in a month, really. And right at the heart of all that was energy markets, and then how that flowed into the energy companies, which I guess price a lot off the oil price. And if you recall back to mobility ground to a halt, and at one point, whilst it was a bit of a headline at the time that oil went negative, I don't think in my time at Morningstar, I don't think I've ever had a time where something was more contrarian than that, and we were going more against the crowd. So on our numbers, it was probably the most compelling investment over the last decade. And if you think about what was happening at that time, everyone was selling off energy, everyone was really bearish, lots of behavioural things that just prices kept going down, and it looked really attractive to us. So we built a position knowing that we focused our position in big integrated players who could survive the oil price being low for longer, knowing that we didn't know how long this was going to go on, and some of the more shale producers, yes, they look attractive, but on the risk side of the equation, we didn't know whether they'd sell through to the end. So we focused on the big integrated players, the likes of BP, Shell, Chevron, Exxon. Now, what happened out of COVID is markets reacted and they came back up, but energy didn't. So everyone was working at home still, markets went back up, but energy was sort of lagged quite a bit, and it became more contrarian, if anything, and our conviction in the position didn't change. So we continued to sort of build, and then the catalyst for when the initial re-rating of energy came through was the development of the COVID vaccine. And yes, markets lifted off, but energy really roared. And I think it's another factor of how we think about positions is it was pretty much at that point that we reassessed what value was left in that thesis, and came to the conclusion for various reasons that was still a lot of value in holding those positions. And we did. And then when we exited and how we came out the other side was, and often some of what I guess the catalyst is unexpected. And in the case of global energy, what flowed through and made us the selling decision, and we have our fair value and where we'll trim things and sell, was when there was that conflict, the conflict that broke out between Russia and the Ukraine, which sent the oil price much higher. And I think led to lots of other flow-on effects through inflation. But that was at the point where we realised our value, exited, and then moved on.
When you think about these, I guess these positions, we've discussed two of them. We've spoken about Japan, much more, or an opportunity that we unlocked over a longer period of time. You've just touched on energy. We spoke a bit about the investment process earlier, and about being risk adjusted, or the focus on risk adjusted returns. When you think about all these opportunities and the various ones that were on that slide earlier on, how do you think about that in a risk-based sense? How do you actually, are they all equal? Are they different? How do you size? How do you think about it in a risk perspective?
I think they're all very different. So they all, like how attractive something is from a return perspective might be very different on the risk perspective. And one that I think is still in the portfolios, but probably fits nicely into considering how we think about the risk side of the equation, was our position in China equities, which is still an attractive position at the moment, but nowhere near to the level it once was. It was a bit like energy, that it was off the page attractive when we had all this, the crackdown around, the government crackdown around China tech and the regulatory stuff for the big heavyweights in China. So I think Tencent and Alibaba, they sold off aggressively at a time when the government was really zeroed in on that. Now, from a return perspective, China looked amazing. But the flip side is you got to take into consideration the risk. And for us, it's sort of fundamental risk. And what does that mean? It's risks to that the cash flows just might not eventuate, that you might not get paid. And some you'll be happy to take on the risk, and for others you might not. And so in the case of China, so there's just some risks that come with China. Yes, attractive position, but there's some risks that you can't get away from that, if they happen, are really outsized, and you want to control through your sizing how much exposure you have to that. And some of the stuff around the Chinese government, what they might do to your assets, and those things are some things that you might not be able to control for. And yes, you're getting compensated a bit through the return, but you can't get rid of that risk. So the way that manifests in the sizing is that we effectively capped our exposure to China, such that if we just viewed it on a valuation basis, without taking into account some of these influences, our position in China would have been much higher than it was. And yeah, we've capped it at a particular level such that we just won't go. We will always trim back to that. We won't let it. We won't keep going up if it gets more attractive. So that's probably giving a bit of a risk lens to the return, which is, I think, a really important part of how we're trying to manage our portfolios.
Okay, that's terrific. So that's almost, 20-year sort of period there of, implementing the same sort of process. So that's a nice sort of, I think, historical look back at, I suppose how you've applied that process historically. Let's look forward. Where do you sort of see things today, applying the same process with a forward-looking lens?
Yeah, sure. So there's a lot here. So what I'm going to firstly do is try and explain what you're looking at, and these are our forward-looking in blue is the forward-looking expectations of real returns for a select group of assets, and we model over 300 assets, but these are a select group. So in blue is our forward-looking real return for these select assets. What makes up that is the underlying fundamentals. So for an equity, think dividends and buybacks that you're getting from an asset, plus the underlying share growth, and then you either add on top a valuation discount or you take off a valuation premium. And then in green and orange are the change in those returns since, in the case of the green, since June 2023, and then in orange, the change since a year ago. Probably just to level set people's eyes and just give you an idea of maybe how things compare. So if you look at Australia, is probably in the middle of the screen here. So Australian equities is just in the middle here. And then on the right-hand side, Aussie Treasuries are right down the right-hand side here. So it gives you a bit of a level, a base from what to look at. Now, so where are we seeing opportunities? And generally, we want to focus our attention on the left-hand side here. So where are we seeing opportunities at the moment? Emerging markets is key. So in terms of where our focus is at the moment, Brazil, despite strong performance in China, returns have come down, but still looks attractive. Mexico, so Latin America, China. And in the case, if you think about the backdrop and think about Brazil here as an example, there's lots of noise in Brazil at the moment. Inflation is still roaring. The cash rates are really high. That's partly what's creating that opportunity in Brazil, that the local investors can get higher returns on just cash accounts, so they sort of don't have to be in the equity market. So that's some of that noise and us trying to ignore that, look through there. So emerging markets is another one. Then there's sort of a group of assets that I'd sort of talk about being consumer cyclicals and defensives. So and add to that US healthcare or global healthcare. So there's a few pressure points coming through some of these consumer cyclical and defensive things. Think tariffs, think cost of living pressures, think China as well. So there's a few things zeroing in underlying costs, really creating noise, which is, I guess, a bit of a disconnect for us if we take that out, look at the long-term focus on. So that's a group. Then if you think about US healthcare specifically, so there's been some news in recent days, which is a bit of around Panadol and its impact on pregnancy and potential links to autism. I think those sort of headlines have been pretty common given the administration in the US, and RFK's Jr. is, I guess, at the head of it. He's very much a naysayer of vaccines and just pharma generally. Those companies, high quality companies, have been sold down quite a lot, reflected in a pretty attractive forward-looking returns. Now, whilst our focus is on the left-hand side, that's effectively our starting point. So it's not where we just go, okay, let's pick up all these assets and go. These narrow our focus, show where our research goes, and then fundamental reviews go in and look right into these in some depth.
And if they get through that sort of level of scrutiny, they potentially become the vintages that we showed on the previous slide. You'll take a position and hopefully get the returns within a 3-year period. But if not, they just become our long-term positions.
Yeah, correct.
Okay. Well, this is a good slide. I know in the interest of time, just from the perspective of, I suppose, bringing this all together for folks who are on the call, when you think about how you take all those positions, that forward-looking view of various asset classes and strategies, and bring it together in a portfolio for, say, a 70-30 investor? Or how do you sort of think about that?
Yeah, so this slide here shows our growth real return fund. So, you know, really when you think about the previous slide where we had emerging markets and we had consumer cyclicals and staples and also healthcare, probably pleasingly here you'll see that we have quite a balanced portfolio, whether you look at it from an asset allocation point of view, whether you look at it by region within our equity regional exposure or even our equity sector exposure, is that, you know, while it tells us where to kind of tilt, we will also still to make, you know, diversification kind of calls, and there are still kind of reasons why we want to put that all together in a multi-asset context. So maybe if we just start on the left-hand side looking at our asset allocation, no surprises there in a 70-30 portfolio that we do have, you know, a fair bit in our growth assets being international shares, Aussie shares and property and infrastructure. What you will see is a bigger portion to international shares, and that's really because it is quite a diverse asset class. So we can do a lot of cycling underneath, and we've spoken about China, we've spoken about energy, we've spoken about Japan. There's a lot of differentiation in there, and that's primarily why that is the larger piece. Whereas when we look at the other asset classes, whether it be Aussie shares, property infrastructure, they tend to be quite homogeneous in nature. And then when you look at the bond side of things, we do have a lot more in Australian bonds, keeping in mind that we are Australian investors. So we are looking to kind of manage the downside risk from an Australian investor's point of view. We're not looking for international credit so much in this fund. It will differ for maybe a more conservative, moderate kind of real return fund where we would probably look to have a bit more international bonds there. But in this particular portfolio where it really is about the growth assets and letting them shine and then just providing that kind of downside protection on the bond side. So that's kind of how we position it from an asset allocation perspective. And then looking at it from a regional exposure perspective, here, we still have a fair bit in North America, but, you know, we have a fair bit in emerging markets in Asia, and that really is a function of, as Bryce mentioned, where we're kind of seeing some opportunities kind of tilt towards the Brazils. We also got, as you mentioned, Mexico, China, and then another one is Korea as well, which we quite like. And then looking at from a sector point of view, what we've got there highlighted in blue is what we kind of regard as cyclically kind of exposed sectors. And then we've got in the kind of different shades of red, what we call economically sensitive areas, so they sort of sit in between. And then we've got the defensive areas. And it's fair to say, as Brian just mentioned, we like the defensive areas of healthcare and consumer defensive, but utilities is another defensive area which we have a much smaller portion to, just because the valuations are quite expensive there. So we will kind of, marry up having a defensive and kind of cyclical kind of exposure with valuations as well.
Makes a ton of sense. I'm very cognizant of time. Just want to give you both the opportunity just to give any sort of key takeaways or final comments.
Sure. So I think a really important one and is that experience counts. And I think Bianca and I have been here. I've been here over a decade, and Bianca's well ahead of me, although she might not like me saying that. That experience counts. We've got a disciplined investment process, which is, I guess, grounded in pretty strong principles. And we've been around, and I think you've seen some of those examples that we showed through multiple market cycles. And I think that's important. And then on top of that, if you think about the managed account space, like we've been doing multi-asset portfolios in managed accounts for well over a decade. And so we can hand on heart say that we've been around some multiple market cycles, know, tried and tested through that sort of those environments and multi environments. Then the second thing is like looking through the noise. There's lots of noise through markets, whether it's day-to-day or big macro-based shocks that come through, whether it's a COVID-19 like environment. Most of the time, honestly, like we ignore those little moves month to month and day to day because they frankly don't matter much in the long term. But you do get those big market shocks, which are actually more opportunity than anything else. And I guess you're playing on some of those behavioural biases hidden in everyone, that people hate losses. So losses are much more exacerbated when people are fearful, and that's when you can unlock long-term value, buying cheaply, and so we can have some of those opportunities, those vintages continually from here, and they'll happen.
I think as well, patience pays. I mean, I know you alluded to Japan before. That definitely was one that we had to be very patient. But definitely a long-term mindset is very important. So as all that noise is happening over the short term, we really need to look through that, and we see that as our behavioural advantage to kind of have a longer-term horizon. So if you think about brokers, and a lot of the market news that happens there is really focused on very short-term kind of timeframes. We feel like by adopting a long-term mindset and being more patient, you can kind of, realize those fundamentals, and as that price is fluctuating. So we really think that is important. As well, we look to be positioned for opportunities. So we do look to be differentiated, as well as being balanced, and where we see opportunities today, as I've mentioned, select opportunities in emerging markets, healthcare, and the consumer cyclicals and defensive space.
Okay, terrific. Look, that was a lot to get through in 30 minutes. I think you did a great job of sort of talking everyone through that. Just wanted to thank you, Bianca, Bryce, for the insights today. Certainly for anyone on the call, if you do have any interest in pursuing any of these topics that we've discussed in more detail, please just feel free to reach out to our business development and advice solutions team in your state, and they'd be very happy to connect you with our investment team. I think with that, thank you to anyone who did submit questions ahead of time. Really appreciate it. Thanks for your attendance today, and enjoy the rest of your day. Thank you.
Any advice in this video is general advice prepared by Morningstar without reference to your objectives, financial situation, or needs. You should consider the advice in light of these matters and any relevant product disclosure statement before making any decision to invest.